Adjustments. Now this is huge. This is the big picture here. This is the most important thing. Nobody teaches this. Absolutely nobody teaches you how to do adjustments. You can learn bear call spreads. You can do bull call spreads. You can do put spreads that are bearish. You can do put spreads that are bullish. You can do all kinds of different kinds of weird, you can do collars, and you can do all kinds of different positions. And a lot of people teach that. They teach you how to put these positions on, but generally what they want you, they need you to have an opinion of the direction of the market. Well, with our system, you don't need that. This system does not require you to have an opinion of the direction of the market. So you don't have to do technical analysis. You don't have to know anything about technical analysis. If you know how to manage your business by the numbers, then that's all you really need to know. If you know how to put trades on, then, like I said, these are not one-dimensional trades. These are multi-dimensional trades. They're easy to do. They're easy to adjust. But adjustments are everything, because nobody teaches you what to do if the position goes bad. I mean, you can put on a bull call spread, and, if prices go up, yes, you make money. But you know what? You're not going to make the maximum amount of money until you get to expiration. I mean, if you have done any type of spread option trading before, and you've put on bull call spreads, let's say you bought a IBM $5 bull call spread, and you bought it for $2.50, and at expiration it's worth $5 because the strike prices are $5 apart. And the market in IBM has gone up, and now all of a sudden, for $2.50, all of a sudden it's worth $3.50. Then you want to be able to take that profit, but at expiration it's going to be worth $5. So you kind of hope and pray that it goes above that your short strike price, and you get that full $5 of profit spread that you put on. But then what happens? IBM turns around and goes back down. All of a sudden your spread is now worth only $2, and you paid $2.50 for it. Well, you know what? There's an adjustment to that position that can lock in your profits at $5 if you only knew how to do it. So adjustments are absolutely critical. It's very, very important for you to understand how to do adjustments in your positions. And we don't do just one-dimensional type of positions. We do multi-dimensional positions so that we profit doesn't matter whether stocks go up or down. But adjustments is really the big picture, because nobody teaches it. They teach you how to put on these one types of positions, either spreads or calls or puts or whatever, and that's it. And if they don't work out, you take a loss. If they work out, you make a little bit of profit. But I don't think that's a great way to trade. I did that for years, and I had 50-50 success. Some months I made money, some months I didn't make money, and it's a very, very, you have to have some market direction. And if they don't work out, you get killed. And if they do work out, you make a little bit of profit. And that's not a business. That's a gamble. This is a business. We're managing our portfolio by the numbers. We know how much profit we're going to make every month. Okay, then I go into closing our positions, our profit and loss. Let's take a look at our profit and loss closing positions. And this is absolutely critical, because what we want to do is we want to close out the positions at the right time. And this is where you want to take a look at this picture again. You want to analyze your picture, because when you get to close to expiration, that white line moves all the way up here, and it's very, very close to your expiration full profit. And if your position is looking really, really good and it's in the center, you might want to hold it another day or two just to see how prices go. But in general, once you get to the point where you've got a substantial profit in these positions, you can close them out. It's not going to hurt. You still make your profit. And you know what? You don't have to be in a hurry about closing out your positions, which is nice, because you have so much room to move in price on a daily basis that, it's not going to hurt you if you don't close out your position one day, or you just you got busy with something and you want to close it out, but you forgot, or you didn't get the price you wanted, or something like that, you can afford to be patient with these positions. You don't have to. It's not like day trading where every little tick counts. In this type of trading, you're putting on positions, and you don't have to settle for market prices. In fact, I don't suggest you settle for market prices. The nice thing about the Thinkorswim platform is it allows you to get in at the mid prices many times. It depends on the market, of course, but you can get in the mid prices, and if you can't get in the mid prices, then you can move up your little bit by little bit, and those the money that you save from trying to get mid prices really helps pay for all the commissions that you're going to be generating. Now, the commissions are very, very reasonable on Thinkorswim, so I don't even want you to consider that, because they pay for. These positions pay for themselves and make a great profit. So commissions are really not a major component of your expenses, but they are an expense, and that's the only expense that you have in this type of business. That's your overhead, your commissions, and that's it. And I think they charge $1.50 for an option trade. A couple of options is going to cost you $3. One option is going to cost you $1.50. So it's not a big amount of money, but it is overhead that you have to pay. So closing out the positions is the next video set that I do, and it's very important that you understand how to close out your positions. You're not in any hurry. You're not day trading, so you can actually take your time, close out your positions, make sure you do them the right way, collect your profits, and you know what? Move on to the next trade. Then finally, we go into the big picture. I take a look at some technical analysis stuff. I have a proprietary technical analysis tool that I use to determine how the market will open every single day. And it's been right 95% of the time. It's very, very close to being right almost all of the time. And it's very interesting because a lot of times that the futures will trade before the option stock market open. And a lot of times, I remember just recently, a few days ago, the futures on the S&P 500 were down like $9, which is a pretty big down move before the open. And so everybody expected the market to kind of open way down for that day. But my proprietary indicator indicated that it was going to be a flat open. In fact, it might be a little bit up, and it did. It opened basically down about 5 points, and then the Dow Jones Industrial started going up 20, 30 points. So it's a very, very interesting indicator to use. It's a proprietary indicator that I came up with, and I'm going to give that to you absolutely free as well. I also talk a lot about the VIX, and if you don't know anything about the VIX, don't worry about it right now, but it's a very, very important tool for stock trading, and especially for our types of positions. It's probably one of the most important tools that you can use to determine future direction of stock market prices, at least in the short term.